This is the HackerNoon podcast, and today we have a couple of decentralized solution providing, and they would be joining us on the podcast today to discuss what are the mistakes that entrepreneurs make when they are trying to pitch their solutions and products to VCs. And we would also go deeper into, is there a special language that entrepreneurs need to learn when pitching their products in front of VCs? Our guest today are Christian Kameir, who is one of the managing partners at Sustany Capital, which is based out of Newport, California. They invest in, among blockchain solutions, they also invest in decentralized software, Web3, and so on. Joining us also right from Europe would be Jamie Burke, who is the founder and CEO at Outlier Ventures. And fun fact about Outlier Ventures is that they were the first VC fund based out of.
Good, how are you, sir?
So let's start with a softball question. So with names like Christian Kameir and Jamie Burke, what did you guys want to be when you were growing up? Because the way I see it, that name sounds VC. I guess like your parents were like, okay, my son's going to be a VC. Hence, let's name him like that.
I'm happy to correct that very quickly. So I didn't even know what a VC was until I was probably about 25 when I was faced with trying to get money out of one. I'm still trying to figure out what a VC is now. But what I do is I run an accelerator. So definitely not predestined to be a VC. I'm underqualified to do most of the things that I do on a daily basis, which is why I augment myself with brighter analysts than me.
How about you, Chris?
Well, actually, at a very early age, I wanted to become an author and a writer. And so my first purchase that was relevant in terms of money that I could scrape together was actually a typewriter. I think I was like 8 years old. And so, yeah, one of the fun facts is that I actually intermittently enrolled into literature school to like classical literature after I studied software engineering and then eventually went to law school.
This is nice. And here's this fun fact about Chris. So he is one of HackerNoon's top writers, and he is also a member on this technology council. Moving on, let's talk about blockchain solutions. So what is it that makes you guys look at a project and say, hey, this is a project that I would not touch?
You want me to go first, Jamie?
It can be a long list, I can understand, but
well, yeah, so we work more directive in the sense of so that we actually formulate our own investment thesis on very nuanced topics and things we like to see in the world. From a personal interest, after I sold my last startup in 2008, where we were trying to build Yelp before Yelp, I kind of started to realize that we actually never even finished building Web 1.0, right? And so at that point in time, I started to write an outline what it would take to build the web, albeit I think my first iteration in 2008 actually probably didn't use the term DC, just honed in on a very basic how you need to structure the distribution of information. But so based on that, over time, we started expanding very rapidly on these theses across many different verticals. So if you talk about money as a technology in general, then lending, payments, and so forth. So we have a thesis that's very nuanced on all of those. So when we approach startups or they approach us, essentially it's part of our peer review process where we run our thesis against theirs. If they have one, and it's a big red flag if they don't have. We are very data-driven, meaning we want to see all the typical KPIs that you're looking for. And even though it's often harder in this kind of paradigm shift of decentralized software solutions to come up with a business model, as a startup, you actually should have a thesis on how you're eventually going to make money. Because at the end of the day, that's how you're creating returns, right? You're solving a problem and someone is willing to pay you something for it. So hope and pray, it's not really a strategy that we subscribe to. And the other part of, you asked about red flags is, and we touched on this in the prologue, is there's a lot of insecurities around the correct language of things. And again, even though if your definition might differ from mine in terms of what is blockchain, what is DLT, what is blockchain technology as divorced from blockchain itself, what is a graph-based solution, how do you define identity as a technology and management thereof. So at least have these definitions, even though, again, if they might be different from mine, and maybe I can learn something for it, but because our focus is on software is language, right? And so your primary thesis should be even more accurate that you just write down in regular day, let's call it English, or whatever your native language is. It should be more accurate than what you write in code, because if you can't even spell this out in regular language, you're going to have a hard time translating this to something that's going to be relevant software code, right? Did we lose Jamie?
No, I'm still here. I'm still here.
Oh, okay. Sorry. I kept talking because I thought you dropped.
No, I'm here. And it's interesting. Maybe I build upon what you were saying. So you mentioned the paradigm, and I know you're probably as embarrassed as me to use the word because it's so overused, but the reality is, I guess we both share the understanding that we are moving into a distinct paradigm shift, hopefully. And that is both in response to the web as it is today, but also what the web could become. And so to go to your original question, like what puts us off, I think ultimately, so we have a thesis, we operate at a very particular stage. So we're seed, we're an accelerator. Staging is the first thing, it's too late. But, and then we have a thesis, and I'll break that out in a little bit. But the first thing for us is that the startup understands, in front of us, understands the paradigm shift. And as Christian was saying, we might have a different way of talking about it. We might use different verbiage and everything else. But the reality is that most startups are building in the old paradigm. So Web 2, they're building a business model that's predicated on closed source technology, proprietary technology, shareholder supremacy, and this concept that there's a platform and you lock people in and you extract as much value and data as possible. And that's, I believe, if you're birthing a startup into that kind of paradigm, it's stillborn. So it might make money for a little bit. It might be acquired by the incumbents whose business model is that, whether it's Facebook or Google. But I believe, mid to long term, that is redundant and will very quickly be replaced by an alternative web. And so again, to build on some of the things that Christian said, we're a purpose-driven investor, not necessarily because we take a moral high ground. We just believe that there are certain things about the web that currently don't work. Yes, as a citizen, as a user, we think they're bad. From an investor perspective, as a venture capitalist, we also think it's bad business because it's long-term unsustainable. And so the things that we look for in startups, and we use this term Web3, we're discussing with Christian, that's something they subscribe to too, depending upon the conversation. But Web3 for us is about user-centric. So rather than platforms, which is how the web's currently wired, is user centricity, where the user has increasing control and portability. They can exit, they can have a Brexit moment with Facebook or any other platform.
Yeah.
And they can take their identity, their connections, their assets. And increasingly, as we look at this in another buzzword like the metaverse, right, as more of our wealth becomes digital, so that could be crypto, it could be in-game collectibles, increasingly wealth is digital. And so I want to be able to move that around. I don't want to be locked into a platform. And so these are all characteristics that we want to see in a startup. And at the heart of that, again, another slightly nebulous word, privacy, but we want to see privacy by default, or at least the user has control over the level of privacy that they want when they engage. And the kind of final point that I would say is that we want the rules of how a user engages with a platform, because there will still be platforms, that kind of T's and C's to be explicit and hard-coded and auditable. And I think that's a big missing piece. If you look at most platforms and the way that most people engage with platforms today, they actually don't understand the terms. And if they're written out for them, but they're just deliberately made impossible to navigate or understand. And I think as we move to things like blockchains, the rules are hard-coded. They're not necessarily by everybody, but by somebody who has a technical proficiency. And so we think this enables a more trusted web environment. And we think that's critical as we trust more work to automation and things like machine learning and AI. So for a startup, you might not understand all the nuances of that, but if you don't intuitively understand that the direction of travel is heading that way, then there would be no point us investing in you. We can add value to you, and we would think you're long-term unsustainable.
So this is the first question, but I would have to request you to take a step back and explain to us what does the word investment thesis mean, right? When we spoke about the verbiage being different, which both of you guys said that the languages can be different, but more than the word blockchain, more than the word sustainability and stuff like that, both of you use the word investment thesis thrice, and I have no idea what.
So we have let's call it a very high level macro thesis, and this goes back to like all of human history. So if you look at a typical presentation that starts evolution of money, a lot of times these will start at the days of when we did barter, and that's 10,000 or so before Christ. If you think about it, that's really not true, because throughout the existence of humans, we've worked on social contracts. We worked on the fact that we collaborated and that ensured our survival. And that, to a large degree, is still true today. So the larger point there is that for probably 98% of human history, we used our brains to keep tabs of these debts that are owed. I brought you something for dinner and you brought firewood, or something to that extent, if you want to make it very simple. So I call that the wetware ledger. So the brain ledger. And then eventually we moved to something more sophisticated like paper. And then very recently in 1960, we introduced databases. So the problem there is, yes, we evolved in terms of using these technologies, but then I think we made a huge mistake, which is we connected all of these databases to networks. So these databases were actually never designed to be connected to networks. And so we exposed all those entries basically to anybody. So as a kind of default statement, I would say that any data that is in a database has been stolen and or will be stolen, right? And we have so many examples, it's not even funny anymore. And it was Mark Andreessen who said this is part of the original sin of the internet, right? But it goes back to the fact that in big picture thinking, we came from wetware, moving to sticks and stones, to paper, and then databases. And so now we need to look towards decentralized software solutions or blockchain-based solutions or graph solutions to fix that, to give us back control over that. So that's a high-level thesis. So everybody who is using a database right now, who is the sole proprietor of that database, has that database under control, prepare to be disrupted if you are still the one maintaining this data silos, because we will actively invest in companies that will do exactly that. And they are, the starting point is those that are actively violating, like Jamie said, your privacy, which I'm super passionate about. I think that is a horrendous business, the data collection and then targeting. This is what we do today, right? This is the predominant business model of advertising companies such as Google, right? So they create profiles. It has nothing to do with identity. They create profiles, and the reason to create profiles is to target you. Advertising or something else. But the biggest thing here is, as technology evolved and we introduced AI and NLP systems and so forth, we actually went down the slippery slope to the extent where now we don't even have advertising anymore. We basically have social engineering as a service. And that's the most predominant hacking tool that people use, right? If you look at all the original hackers and what are their technologies, 80% of all hacking is actually social engineering. But now we have this as a service, which is mind-boggling. And so finally, here, the Justice Department is cracking down on some of the behavior of these companies, albeit I think they're not going far enough and they don't understand the actual damages that these technologies are doing, right? Because at any given point in time, what's really being stolen is your time and attention, right? So that is what's being sold. It's not the click, it's your time and attention. And the more time and attention I can extract from you and then derive some return on my investment, that's what I'm going to implement. And so on a very high level, the thesis there is, okay, we need to reverse that model. We need to go from, let's call it the push model, I push things in front of you, to a pull model. And that's the very high level part. Then within that, we have about a dozen different theses that are very long, that pertain to things like money technologies, pertain to things like lending technologies, identity, quote unquote, technologies. I typically don't use the term, it's somewhat incorrect from a legal perspective, but within those, we have many more different theses how we see things out. I'll just mention one and then I'll let Jamie talk so I don't take over the conversation all that much. But we look at this very high level from what are the total addressable markets right now, right? So if you look at things like payments, like a $2 trillion segment. So I expect this space to go to zero. What I mean by that is in terms of ability to generate alpha. Because kind of the gold standard in that space is what you do on a daily basis with cash if you're using cash, right? You hand it over, you don't have it anymore, the other party has it, there's no KYC requirements, and the transaction is settled instantly, right? There were no fees involved typically. So you need to move backwards from that. And that's why the high level thesis is like there's no alpha in payments. So explain to me where you're making your alpha from if you provide and pitch us with a payment solution, which we've seen probably. Anyway, I'm going to give it over to Jamie now.
No, definitely. Like Jamie, go for it.
Yeah, so maybe there's two parts to it. So the first one is, because I think your question was more general about what is a thesis or investment thesis. And so the way that I would describe it is ultimately Christian and I are placing bets on a couple of things. One, the future, and two, the ability of a team to execute on a use case and that future. And as a VC, you collectively, as a group of people, form a thesis. It makes it sound much more scientific than it is. Maybe Christian's is a lot more data oriented than ours. For Clearly. Us, because we're early, it's much more intuitive. Like we invest in seed, right? So we're right on the very edge of what's coming down the pipe. There's often very little data points. And so you see general shapes. We speak to 1,000 startups a year. And those conversations actually inform our view on A, technological innovations, B, the speed of those innovations, like how to time them. And then the third thing is where value will accrue, right? So as an investor, my thesis should allow for all of these things. But most importantly, like where will value accrue in this future? So is it going to be in business type A, B, or C? Is it going to be in the network? And in things like blockchain as a paradigm, it really challenges the concept of a startup. Typically as an investor, a venture investor, you make money by investing in the equity of a company. In the decentralized space or web, there's multiple ways you can be exposed to where value is created. For example, a cryptocurrency and the sophistication around that cryptocurrency is evolving, as the name would imply, or it can provide another kind of function in what is normally an open source system. So it can look a bit like equity, it can have governance rights, it can have yield. And so really, we're exploring where is value going to accrue in this new environment when it's no longer centered around the equity and a shareholder. It's going into a network and all these different participants. So really what you're doing is, and there's a great book, by the way, called Master Switch, and this looks historically at technological innovations from the radio to any number of things, cable TV. And it looks at what's called this bundling and unbundling. So a particular innovation will come to market and an industry will form around it. And usually value tends to then centralize into monopolies. And then a new technology will come along and it will unbundle that whole industry. And then normally it gets bundled back up into monopolies. That's historically the pattern. And so really, historically as a VC, you'd be saying, okay, how can I make bets on where value is going to get bundled, where players are going to monopolize a particular industry? Now, I think with Web3, what's interesting is there is definitely a bundling of value, but I don't think it will necessarily be in like a company, a single company, a Microsoft or an Apple. It may be in a network. And that might not be for this podcast, but these kind of considerations. And so when I say we have a thesis, it's something we can articulate to the world that ideally attracts like-minded startups who say, I share that vision and I see my place within that vision in a way that unlocks our capital. And we can try to de-risk how we allocate that capital ultimately to make a return. Because at the end of the day, we're capitalists. The venture part implies a higher degree of risk appetite, effectively.
Got
So maybe one moment to add to that would be, I think both jumped over initially. Jamie hinted on that. It's about predicting the future. So it's all about timing, right? It's all about understanding, in our case as technology investors, where's the technology now, right? And if we're looking at the blockchain space, and oftentimes I think for good reason, we draw analogies to quote unquote Web 1.0, and we built an internet dial-up service that we sold in 2000. So for me, this is a lot of these things are deja vu. So I can relate to all of these anecdotes and metaphors in that space. So if you go back in time and you would enter the internet space at 98, and I think we started 97 or something. So you had dial-up modems where if you wanted to load an Amazon page, it would take you 90 seconds to open a page, right? So our big advantage, and that we were able to sign up like 3,600 users a day, was the 50s modem, which sounds really funny today. But honestly, that's about where we are now in terms of the blockchain space, right? And that's if you just count every wallet out there as a user of blockchain, which is probably not quite fair to say, considering that most people have a wallet in conjunction with some centralized exchange usually. So the actual numbers probably much lower. But then if you just observe the space over a number of years, you can see what companies are being built around. And some of those are already somewhat successful than compared to the Web 1.0 stages. If you look at Bitmain and Coinbase, all of those have already exceeded the $10 billion mark in valuation based on the last raises. And they have only been around since 2013, 14 respectively. So you get a little bit of a trajectory that you can point out, and then you can make predictions. What are the kind of changing points that you see in the future when there is quote unquote mass adoption? So if you take the typical gut, think back to the invention of Bitcoin in 2008, 2009 with the network launch, and then we had this inflated expectation period before ICO craze. There was a lot of delusion afterwards, and now we in the, if you want to say, enlightenment phase, and it's plateaued a little. So what's going to be the impetus for mass adoption? So for Web 1.0, it was funny enough, came modem, but then obviously more important broadband. And so for the whole decentralized software solution space and blockchain space, since initially it's going to be focused on finance, we think it's all the on and off ramps. A lot of focus has been given to kind of the core technologies in the center. But if we look at the companies that are profitable right now that we invested in, their focus is on the on and off ramps. How do you onboard assets from the past that typically lived in database solutions onto a blockchain-based solution? If you look at Provenance, for example, they're super successful, right? And they're already make multiples of what any other startups combined do. They're just focused on the actual software space because copyable easily, right? And a lot of these solutions are open source. That's why we saw like the whole DeFi movement like jump from one solution to another, because there's no barrier to entry in that space. The barrier to entry is in the hard work and on the onboarding. We had to send 1,500 affiliates around to onboard internet users in 1999 because you had to install a dial-up modem and put it into your wall and then configure it to our dial-up system. That's where we are now. So that's the hard work that people need to be doing now. And most of developers are not doing that, in my opinion. That's why always my call to action is show me how you onboard people, like real people, right? They have a real problem, a real world problem.
Got it. And again, I want to pretend that I'm smart, but with you guys, it's not gonna happen. I'll pretend that I'll speak for the little guy who doesn't get these things. So I will give both of you guys a scenario. Let's say that I have a startup and I want to raise funds, right? Based on what you guys explained to me, thank you for that, is that I should first do a competitive research as to who are my competitors, and then I should go after the funds that invested in my because that would align with your investment thesis. Am I right in doing that, or should I not do that?
Yeah, I would say, so as I said, we speak to 1,000 startups a year. In the context of Web3 and blockchain, we've been around for 7.5 years, so call it 7,000 startups. We've invested in, so, you know, that gives you the math as to the projects that we find in. And there's a handful of things that I think are universally true about good founders, irrespective of whether you call them a blockchain startup or anything else. The first thing is that you want executors, right? So ideas are really cheap. I've never yet met somebody, maybe one or two people, that have presented me an idea that nobody's ever told me before. Totally new idea that I've never heard before. And so the starting point should not be, I have this unique idea. It's that there is this idea. I'm assuming that at least 10 other people on a planet have it and are executing on it right now. It is how I'm going to out execute them. So like a key thing for me as a founder that understands perfect is the enemy of done. Like just do it, get it out there, build an MVP. This is classic lean startup thinking. Get it into the hands of your customer. Ideally, the founder is the customer that they're trying to sell to. You also see a lot of founders who are basically just, understandably, we've all done it, trying to think of an idea that's going to make them money. But it's not something they care about. It's not a market that they care about. It's not something that they would be doing even if it wasn't going to make them money. So I think the best startups are usually ones where if you ask the founder, if you did it and it failed, and 90% of startups fail in their first couple of years. So would you still do it anyway, even if you knew it was going to fail in a year or two time? Because I think if the founders can be passionate about it, irrespective of its success, it's more likely to succeed because they are their customer. They're solving a problem they want to see fixed in the world. And they don't need to spend hundreds of thousands, millions on customer surveys, right? They are their customer. They know the pain point. They're from the community. They're credible. And they're this execution focused. So there's no point. Most startups run out of money trying to establish what you call product market fit. Does somebody even want the thing that I'm trying to build? And I found the more engineering focused a team are, the more they want 10 million pounds to go and sit away and be uninterrupted for a year whilst they solve this really big, complex problem beautifully. And the problem is that sometimes they come out of the bunker and realize that nobody cares about the thing they built or the world's already moved on. So like speed of execution, people that just are their customer, they want to be in front of their customer, I think ultimately works. And I think to the point that Christian was saying earlier is timing. There's a lot of luck involved in being a startup. Now, some founders, maybe it's only retrospectively, seem to have an intuitive feel on timing because a good entrepreneur will have 10 things they could execute on, like 10 opportunities in front of them. And I've done it. I've been an entrepreneur. It sounds like Christian has too before he was an investor. You can raise a lot of money. You can be half right, but very wrong from a timing perspective. And so the ability for a founder to somehow tune into timing, to quickly pivot if something's not working rather than slog a dead horse, I think is critical for success and probably universal across most categories of startup.
Got it.
I would echo a lot of what Jamie said. And we just took a flyer on a small startup with just 2 people, but they already had a lot of traction. They are used by most people for that particular solution that they build in this small niche. But usually the best pitches are those that you can do on a napkin, or you can do the math on your return on a napkin. If you do your homework, you should be able to do that. Right? That should be your starting point, in my opinion. I mean, I've in between doing these. And first thing always you should do is at least have a thesis. And that thesis almost will never work out this way, but at least have a thesis. It's kind of, if you don't have a plan, it's like you're planning to fail, right? And so the larger point there is, in my mind, having done this for some 20 years now, it's relatively simple. I work backwards from show me what the potential total addressable market is. And if you're providing real estate software, don't tell me the total addressable market is the value of all real estate, right? Particular segmentation is, then show me how you can capture that market. And it should fit within our investment time frame, right? And you should, to a certain degree, understand how C works as well, right? And plan on how you execute on VC, not only on product development, right? Because what we see, not an insignificant number of startups that come in with an initial thought of a valuation of $30 million wanting to raise 10. There's no strategy behind that, right? You also need to have a strategy to fundraising itself and understand how VC works. And there's lots of examples for that. And we put one online because it was repeated so many times that we simply not even got the basics, even from people that would go through like very prominent accelerators in the Bay Area. They would send us decks. They were missing 50% of what we just need to see in order to do evaluation, right? Show me your typical data. Show me you did research on your customer acquisition costs, your typical KPIs, and nothing really unusual. But I think we gotten to the point where it was relatively easy to raise funds if you had some prior exit and so forth. I don't give a whole lot of value to that fact. We had an exit very early on with our second startup when the first startup failed. And there was so many things that had to come together for this to work that I just know from personal experience, that is really gonna be rarely the case. So if that's your strategy, that's really not this particular vintage of investing. How gonna to be able to justify an ROI? If we give you $1 million today, how's this $1 million going to be potentially $100 million in 5 years now, right? Have a thesis on that, explain it to me. But you should do this for yourself too, right? If you're running that startup, at least have a thesis on that. And oftentimes, in a close with that is what we see people do, they solve the technology problem, which is great. I love that. Engineer it hard, right? But you need to solve a people problem. Like,
got it.
It's people that have the problem. And so if I not need to learn a new language to use your software, well, this is the largest friction you could introduce. And that's what we mostly see in this particular space. People invite you to use their software. First, you have to learn my language so that you can start using my software. That's not a good idea, generally speaking. Anyway.
Definitely. Jamie, the next one's primarily for you. So Outlier Ventures has an accelerator program, and you guys like go through, let's say, 1,000 products every year. So when it comes to blockchain technologies, Web3, there is this need for auditability of the code. Like codes can be audited, yes, but because the technology is so nascent, there will be cases where nobody knows whether the bug exists or not. If you go with the standard like things that we hear about Ethereum, we all know about the parity attack, right? Those guys were selling their wallets and then they come to find out that there was this very simple switch and somebody just switched it off and nobody knew about it. So how do you guys take care of problems like that? Do you guys audit the code? Is there a risk that you consider to be an acceptable risk? And how do you guys proceed from there?
Yeah, it depends upon where you are prepared to play on the spectrum of innovation that's happening in Web3. So if you're looking at institutional adoption of a technology, then there is a higher requirement around security and various other considerations. And to be blunt, like most institutions are not even close to adopting most things that happen on public ledgers, right? It's quite far away. If you go to the other end of the spectrum, which is say DeFi, decentralized finance, which is innovation right at the edge of what's happening on top of primarily Ethereum, effectively people are executing, actually I step back. This is an incredibly, I call it hyper-competitive environment for innovation.
Agree.
So the ability you don't even roll out a business. It's not even necessarily something you would class even close to an application. Somebody can take a smart contract, they can copy it, they can fork it, sometimes with no changes, sometimes with some minor changes, and that thing can end up having $1 billion flow through it in a couple of evenings. So on the one hand, you can say, shit, that's really scary. At the same time, it's very narrow, it's very niche. The users of DeFi is probably like 1% of crypto, and crypto is 1% of anything. It's still like a very small niche group of people. And so if you're going to invest in DeFi, you have to be comfortable. You're wanting to tap into the rate of innovation and the low barrier to entry that somebody can literally spin up a smart contract if they're great, a couple of hours. even if they're bad a couple of days. Now, what comes with that rate of innovation is that, there's poor code audit, if there's any at all. And so individually, there's risk associated to that one smart contract or DeFi protocol. But in combination, because of the composability of this stuff, people will combine DeFi protocols without understanding the attack vectors. If I attack an oracle, i.e. the thing that can have a data input that can change the state of a smart contract, the smart contract, its security itself, or even the economic attack vectors. So just the economic design, can I game that to borrow here, take some leverage here, attack this and make a short-term profit? So the level of complexity of attack vectors, it would take you a year or more to understand it. And that can't keep pace with the fact that people are, because it's an open source environment, copying, deploying, tweaking, changing various parameters. So on one hand, it's very exciting as a VC, and I love the rate of innovation that happens there. I'm not so bothered about the losses that happen, because I think the people that are playing, there's already a high level of technical competency to play that game. I couldn't personally play it, for example. So even I'm, as a professional investor, precluded from directly participating in that game. So playing that game, the risk, and if you lose your money, hey, that's your problem. I think over time, what you want to see is that stuff mature. And so to attract institutional money, like real meaningful money into DeFi, there's a number of things that have to happen. And the removal or mitigation of risk is one of them. And so that's why, for example, there's kind of several things. I did a post recently called DeFi 2.0 that was looking at retail adoption and institutional adoption of DeFi. But if we focus on the institutional piece, it's things like, how can we have more trustful oracles? Because that's one point of attack. How can we allow for fundamental analysis and understanding of economic risk? But actually some quick fixes. And this is already starting to happen with things like Nexus Mutual. How can we mutualize the risk of having capital deployed in DeFi? And so like most industries that are new, no insurer is going to insure you for risk in DeFi, right? They just can't quantify the risk. But what we're starting to see is DeFi mutualizes risk and insures itself. So we're starting to see that emerge. And so I think there are ways to begin to mitigate risk technically and commercially around DeFi as it matures. But if you're investing in DeFi now, which we are, then you're deliberately investing at the very edge. There's a lot of money to be made. There's a lot of risk. That comes down to your appetite as an investor and what you believe is your ability to assess risk.
Got it. Next one's for you, Christian. So, economy is more about hindsight, and hindsight is 2020. VC is more about having foresight. So we have this entire stream on how the economy works. You have thick books by people who win Nobel Prizes about how to get better at economy. Where's the book on VC? Where's the stream there?
I typically say we have a lot of proof points that economics is a pseudoscience, right? Because otherwise, obviously, every economist don't really change, and unfortunately, are very little understood at this point in time. If you think about what business students learn in terms of money, we have to constantly correct that, right? And something that Jamie was saying earlier, I think is very important to understand. It's the unbundling of function. We have already unbundled the functions of, or the use cases of money some time ago. And people who are successful in business have realized that. Those who are unsuccessful have not. What I mean by that is, so the remaining function is simply that of language, or what we call unit of account. And that's what I said earlier. People keep making this mistake of creating new units of account. This is the worst thing that you can do. And if you look at any of your crypto apps, US dollars or whatever your fiat currency in your country is. But the larger point there is that will also then lead you to the realization that the remaining use cases of money, quote unquote, is just spending and lending. And initially, things like stable coins were introduced with the thought that this would address spending. Well, spending is pretty much solved. Payments are pretty much solved for
Right.
most people. That's not a big problem. So that's why we incidentally also see the main use cases in DeFi being that of lending, right? But at the end of the day, it will still come down to the fact that still in DeFi, you'll also see the translation of your DAI, of your Tether, of anything else into US dollar typically. The point there being is if and when governments will actually introduce something like a digital bearer instrument, like a CBDC, that's when we at scale can expect the general population to get involved. It's one of those inflection points, just like a lot of people weren't using voice over IP before there was Skype because it was really complicated at that point in time. There was even before the current protocol to like work with H323, it was half duplex and really cumbersome. But so now you ask your mom and she's using WhatsApp or something on a daily basis. She has no idea that she's using voice over IP and she doesn't care, right? So the best technology, like looking backwards, always is the technology that you don't understand, don't care to understand. You flip the switch, the light comes on. And so that is, I think, even in hindsight, what most entrepreneurs forget to do. Like those little things matter a lot. The little things that will everybody get engaged with your technology, they matter a lot. Spend way more time on that than building like sophisticated algorithms. They, at the end of the day, will matter little, and you can just, like Jamie said, copy the one before that does better than yours. Focus on the actual user adoption, focus on ease of use, focus on people not having to understand what you're building. They just want to use it and be better off for it. Did this answer your question, or did I we off?
It's always like good to hear you speak because you should write a book about these things. Because but
We
because you
are writing a
haven't, I'll
book.
make do with this. Yeah, Jamie, do you have anything to add? But before you do, I want you to explain what DeFi means to you.
Yeah. So if you look in the context of the decade-long journey that we've had with Bitcoin, Bitcoin effectively introduced digital scarcity, primarily in the context of money. So you could have something that is digital and scarce. That's never existed before. The thing that the internet broke was, in most creative industries, had some value, free file, whatever it may be, a movie, and the minute that it touched the internet, I lost control of it. And so that broke most creative industries and most everything else. And what Bitcoin introduced was this idea that you could have something that is digital, entirely digital, lives only on the internet, but that can also be scarce. And then Ethereum came along and said, yeah, you can have digital scarcity and it's programmable. You can program rules into how it moves around the internet. And so the complexity can increase. And all of this can happen in a truly peer-to-peer environment. People used to refer, so I've only been through 2 web cycles, unlike Christian, he's beat me with a 3. But if you look at Web 2, the social web, everyone said, we're going to have peer-to-peer media. We're going to remove all these media barons, and we just replace them with some other platforms. It's not really peer-to-peer, it's mediated peer-to-peer.
With a lot of hatred out there.
That's right. And in the middle of that mediation, there's a tax because they're brokering trust, they're brokering your relationships, and that taxes your data. But here, we basically had this thing where we could say, okay, first of all, it was like a store of value. I think the reality is the argument of what is Bitcoin is long over. I can't see it being anything more than digital gold, to be honest. And that's great. That's a great use case. If it nails, that's worth a lot of money. I think you then had Ethereum, which allowed you, as I said, to have something similar to Bitcoin, but with greater levels of complexity. So you could, it could be money, but it could also be something else. You could have a digital asset which can have totally different characteristics, totally different behaviors that can live on this kind of distributed ledger. What we've seen is in this last decade, there's been this kind of question, or one large socioeconomic experiment is, what is money? And then from money, we've effectively created a proto-capital market, bottom up. So in a lot of ways, we're just replicating what exists in the existing world on the internet, native to the internet. But in other ways, we're starting to see entirely new forms of innovation happen on top. And so at the heart of this, because it's primarily decentralized, it's open source, you end up with what's been called money Lego. So
Right.
the idea that I can build a protocol that
Mm-hmm.
specializes in a particular thing, and that could work with your protocol or Christian's. And they're interchangeable, they're composable. But the combined effect is that you end up with this technology stack, which can do borrowing and lending. It can do interest rates. It could do insurance contracts. It could do all these kind of different functions, different financial products that are entirely digital, that are open source code, that somebody could say, okay, I'm going to copy Christian's version of an insurance smart contract. I'm going to make some tweaks, and then I'm going to relaunch it under a different brand. And so at the heart of this, you've got this, I mentioned it earlier, this competition max. So if you look at the existing financial system, it is incredibly innovative. And there's a reason why. The barrier to entry, the barrier to be a bank or to be a regulated financial services company is so prohibitively high. Acquire the license to carry out an experiment as a startup means you have to be able to raise millions and millions of pounds. So what happens is we end up with this perverse situation where a regulator will say, yeah, we want this bar to be so high for you to get a license to create a financial product, that in the end, only a few organizations can do it. And because there is no competition, there is no incentive to innovate. So the consequence is there's low innovation. And certainly from a retail context, there is low yield. So especially now with what's going on in the global macro environment, some retail bank holders are getting negative yield on their savings account. You have to pay the bank to hold your money. So this is like, not only is this system incredibly inefficient, like there's this huge cost base, people's jobs, there's no incentive to remove them. There's no innovation. So low yield, high inefficiency. It's DNA, it's not controlled by any one organization. It's like an open market. The DNA is, can you remove inefficiencies aggressively? And can you try to deliver as much yield as somebody else? And if you'll be replaced, like sometimes in a matter of days or weeks. So basically, you've got this hyper competition max, bottom up financial system that lives native to the internet, that is innovating on money, financial services, capital markets. And in the same way that Andreessen said, software is eating the world, I would argue this is an extension of that. This is financial software eating the world.
Got it. Chris, next one's for you, and this is a follow-up to what Jamie just explained to us. So we first understood about that you guys have investment thesis, and now we see DeFi, which can become outdated in a matter of like days, weeks, or even hours, like in certain cases. So how has that affected the way that you look at businesses? Did you have to go back to the drawing board to make sure that the investment thesis or the philosophy that you guys adhere to stays true, or did you like have to radically change it?
No, not at all. We take the topic of thesis actually very literal. So in the original scientific sense, you always start with observations, formulate a question, and start doing your research. And I have a really big whiteboard on to the left of me where I used to have the biggest
Can you show it
bubbles.
to us?
I can show you the slide that I put it in. If I can share my screen with you, but I can do this later. I'll just tell you about it. So
Definitely.
if you look, let's take money as an example, right? So broad money, I'm just rattle through it and then we can talk about specifics. Broad money right now, as of today. So you got a lot of money sitting in certificate of deposits and money market accounts. So taking the US example, it's 13 billion at the moment, a little 13 trillion at the moment, a little over that. And this has just shifted because the largest part of broad money used to be mortgages. And so the important part here to understand, and I think that's mostly ignored by people that work in and around DeFi or finance in general. So if you look at money as a technology, you want to look at 4 stages. You want to look at the creation of money, you want to look at the moving of money, and you also want to look at the removement of money from the system. Yes, I think a lot of people don't understand how money is being created right now because there's a lot of talk around the Federal Reserve creating money. That is a pittance. Most money is being created by commercial banks. So most money is created by commercial banks in this kind of mortgages specifically. So in terms of when this money is inflationary, it's inflationary when it's being created for unproductive means, which has been the case for a lot of mortgages, i.e. a house that already existed. So the primary inflation is actually happening to that asset class, and then the secondary inflation is happening to overall money supply. Point there being is the bank that gets to make up that money, they get to create that money, they get it back, right? This is money that didn't exist. The main point of entrance, this is the main point of how they create value for themselves. The interest, okay, that's also nice, but it's on top of that. So DeFi can't compete with that. You have to have that existing money. So it really doesn't matter in that sense. It's a pittance. We have DeFi as a little p in our slide compared to all other asset classes of CDs, mortgages, corporate debt, checking accounts, and so forth. But so coming back to, if you look at from a scientific perspective at these 4 stages, where can you create these technologies? There's a lot of efficiencies to be had, and Jamie touched on it in terms of moving funds, right? Because a lot of talk has been given to like velocity of fiat, and it's being falling down a cliff.
Yeah.
And so we look at this as velocity of the use case. So look at the predominant example for quote unquote cryptocurrencies, which I keep saying people that the number of cryptocurrencies we need is probably somewhere between 0 and 1. Right? But the larger point is, if you look at the current stage and where the highest velocity is, it's Tether. So and where's the velocity? The velocity is on custodial exchanges, mostly in exchange for Bitcoin, right? So that's its use case. It's for people to stay in crypto on centralized exchanges. That's its use case, full stop, period. That's the use case of most of that quote unquote stable coin. Obviously, it's not stable at all, but that's a different point.
Yeah.
So the larger point is, and it comes back to what James said earlier, you got to actually fragment all those different use cases. So while if you read the original white paper for Tether, it was, well, this way we defeat the velocity, the instability of the other cryptocurrencies, and it can start using it for payment. Obviously, no one is using it for payment. Everybody is using it for trading purposes and speculation. And in that sense, and that's the larger point is, and I think Jamie touched on that earlier too, by using the word game, that whole space is very reminiscent of the things that we used to invest into 20 years ago, which is multi-massive online. We had in-game currencies with US dollar exchange rates in the late 90s already, kind of very much deja vu. So comes back to, we look at this in broad buckets. So there's CDs, there's mortgages. So the largest groups of that and out of inflationary assets and get out of the main inflation asset, which is, we call it internally the original shitcoin, which is fiat, right? And so every second that you hold on to your fiat, and actually that's less true for the US dollar than for all but one other currency in the world, you're going to obviously lose purchasing power. Right now, and everybody is already doing this, but is doing it manually, you don't store value in cash, right? So cash is not a great store of value, it's inflationary. So if you can avoid it, and that's the larger point as a big scheme, you want to avoid it up to the point and a split second when someone else wants it for payment. So largest group, and in terms of money classifications by the Federal Reserve System, they call the physical cash is M0, then M1 is your checking account, so your demand account plus that. So the larger point there is, so we got at the moment almost $4 trillion sitting there that's losing value on a daily basis, right? Can you imagine if you just made this available for lending purposes, which is, by the way, that's what the bank gets to do, right? Everybody still keeps using this term fractional reserve. Fractional reserve has never been a thing. If a bank creates, it's a mortgage, right? It's collateralized, there's no fraction. Just that's insignificant in terms of how their business works, but everybody keeps pointing to that. But the larger point there is, this is where they are to be had today. And I and everybody else in this space has been doing this as in, okay, you don't keep $1 million in your checking account. No one, unless you're a billionaire, trillionaire, you might keep $1 million in your checking account, but you typically don't. You move it in that and you keep as much in there as you expect to spend, because that comes back to fiat money is the medium of payment. That's it. Because the medium of exchange for all of these assets is always the same. It's just bytes. Your Bitcoin is bytes. Your 97% of all fiat is bytes. It's just bytes. The task as a technology is, how fast do these bytes move? Because in theory, they all move at the speed of light. All move at the speed of light databases, and these databases are being controlled by regulated corporations, and we won't have any access to that anytime soon. Anyway, so that was a long rant. I typically speak about that topic for an hour, but I'll try to summarize it for this particular example on a high level, because I think it's the most important example to understand that most people still waste their time on not understanding, building solutions that really don't matter.
Just a side note, Chris. So never worry about going off on rants because these are very helpful, right? I'm sure that
Yeah.
there are people who can chop it up into 30-minute episodes, but we try to keep it real. And
Okay.
thank you for that. I have a follow-up question for Jamie, which builds upon this need for velocities, this need for accuracy, although Chris says that we only need somewhere between 0 and 1. So you have been there during the 2016, 17, and 18 ICO craze, and you are probably also, I don't want to use the word exposed, but let's say that you are also invested in certain DeFi protocols or products. What difference do you see between the people who were saying that this is the ICO that you need to go for, this is my product, and then compare it to the people who are building DeFi solutions?
So just so I understand the question, are you talking more the difference between what we saw in 2017 with all the ICOs and now, or was it more about the kind of difference between a
I'll
retail
simplify
investor?
the question for you. So you have seen the pitch decks that was sent to you in 2017, whether you ask for getting the same thing in 2020. How different are they? What is the difference that you notice from the of a week?
So on the one hand, as I said, 90 startups that actually raise money will be out of business in a couple of years. And they're going to be a very small subset of all the people that are out there pitching for money for a startup. Actually, I wouldn't like to know the ratio, but as I said, we've invested in 30 startups over 7 years from 7,000. So that's our ratio of investment. So as I said, ideas are really cheap. And as I've invested in the space over the last 7.5 years, when we first invested, actually, there were no businesses, like actual businesses that you would be able to invest in. Maybe a bit of exposure to Bitcoin, maybe when Ethereum came along, some exposure to Ethereum, but there were no like businesses, classic businesses to invest in. And so we initially were a studio. I got a CTO and I said, look, this stuff's interesting. I don't know where it's going to go. For us to be good investors, we need to have some applied learning. So let's just start building things and spin them out and learn the limitations of the technology. And Christian and I have used this term a couple of times now, time things. So how can we time the innovation? Because theoretically, you can look at a lot of applications and say, the minute you get what blockchain's about, you can go, wow, that is going to disrupt this industry. It's going to enable all these use cases. But the question is like when, and what are the innovation triggers that will enable that to happen at scale in a way that the end product or solution could compete with an equivalent in a Web 2 context. So it has to be faster, cheaper to use. These are the only things people care about. They don't care about the things that Christian and I care about, like privacy or decentralization or monetary policy. They don't give a shit about any of that, right? They just want, people are lazy. And by the way, I include myself in that. I still use Amazon and Amazon Prime, and because I'm a little bit older, I still use Facebook, and I think they're all awful, but I still use them because it kind of got me locked into some of those things that I mentioned. So we were a studio. As the industry evolved, we realized that most use cases were just not going to be possible for a long time. I actually did a blog post back in 2000 and I want to say 4, after speaking to 1,000 startups, which was 9 blockchain startups are bullshit, which was deliberately provocative. But the idea is that all these use cases are so far away because the infrastructure is not there. So we then focused as an incubator on supporting infrastructure to come to market. And we made like several investments. We worked with them over multiple years to bring about critical infrastructure, Web3 infrastructure that would allow for the use cases that we wanted to see and invest in. And it was only recently in the last 18 months that we said, okay, now it looks like there's enough infrastructure where some of the use cases that brought us into the space over 7 years ago might be possible. just technically possible, forgetting everything else and all the other complexities as an accelerator, we're focused on two areas, like very generally. One is middleware. So people taking this infrastructure and making it usable to the 99% of developers. So again, Christian said, people have been introducing totally new programming languages just to be able to even experiment with the underlying technology. The barrier, people talk about adoption of blockchain. Adoption of blockchain is primarily developers. It's not end users. It shouldn't be end users. It shouldn't be end consumers. Knowingly, it should be invisible. Just like nobody knowingly uses SMTP or HTTP. These are just internet protocols that make email work, that make browsing work. I believe the same is true or should be true in blockchain. For us, focusing on people that make all this infrastructure usable for developers, as developers start to adopt this stuff, they adopt the technology for the benefits. And as a consequence, they adopt the principles of decentralization, the principles of user centricity, privacy by default, like willingly, knowingly or not. That's the trade-off that they need to make to accept this technology. We're also investing in applications. So we believe that technically proficient startups, in the absence of a lot of the middle, can still, to a degree, adopt this technology stack and begin to apply it to certain use cases, albeit to a subset of the global internet population. So DeFi being one example. 1% of crypto is using, or maybe 5% is using DeFi. The crypto is a very small subset of the global. So we're finding early adopter communities that can adopt these technologies and apply it to use cases. DeFi is one of them. We're also looking at NFTs, so non-fungible tokens, and their applications in the context of the creative industries, be that gaming, music, art, where effectively people can begin to leverage this infrastructure that's been built, which allows for, in a place of user centricity, creator centricity. As a creator, I can control the terms and conditions, royalties, payments, economics of these digital assets that I create, how people use them, the markets that form around them. We believe that's going to be a crossover. So basically, we've invested all the way through the evolution of this stack the last decade. We think now we're starting to see people that bring a use case and say, I'm going to apply blockchain to this subset of music. We've seen that use case pitched to us probably 100 times. I think it's now that we're saying, yeah, actually it's possible that you could execute on that use case because some of the infrastructure is there. So to be honest with you, the use cases, there's very few new use cases. It's every year we hear the same use cases. It's just the ability for a team to execute upon that use case is starting to be more realistic.
Got it. Thank you very much. And the same question for you, Chris. Like, what is your experience from 2017 to 20? What is the story that your inbox tell you?
What is the story that was? Who tells us?
Your Gmail inbox or whatever email client you use. Because I'm assuming that you guys get bombarded with emails and pitch deck.
Right.
Hey, so this is how this works and so forth.
Yeah. So my partner, who you talked to before, founded the Ethereum Labs in Orange County before their ICO. We were one of the first contributors to their ICO. So what we mostly saw is, because we were doing monthly meetups, at least on a monthly basis back then, was we saw an enormous increase in people to where at the height we had a few hundred people show up to these meetups wanting to learn about investment opportunities and how to build in that space, right? And today that's obviously significant. Also, we have broken it down into way more nuanced topics where we'll have meetings just on ETs, or we'll have meetings just on marketplaces, or meetings on more nerdy topics like multi-party computing and so forth. And so, but we've always been educational in nature and always shared our thesis on these topics for a long time. So typically we channelize the input that we are getting, and we also work with a bunch of different government agencies, always have, in terms of lending our expertise to their vendor selections, or Chief Privacy Officer of the Senate. So it's something that I'm personally very passionate about, and also gives us kind of a free review. I just talked to the product manager of innovative car manufacturing in terms of how to use blockchain-based solutions for our supply chain things. So in that sense, We've been lucky to cultivate the local startup community, then also have kind of international subsidiaries. So we have our team where we have 18 developers developing solutions for us. We have our data science team that we maintain internally. We have our own hedge fund team that we maintain. So they all generalize the things that we look at. So we have an analyst team that will then just give me a concise overview of a particular project, and more often than not, what we will seek to redo. And a lot of those things I start to call intellectual time travel. It's like, okay, well, we've been to that point already. Let's not go back there, please.
Yeah.
If you want to draw some learnings from that, I can point you to an article where either we or someone else has done a good obsessed topic and how it played out based on the invasion in 2017. There's always a few dozen companies that we keep tabs on, right? So there's a lot of passion projects that are personally really that evolve around this whole topic of identity. That includes voting, that includes digital driver's licenses. We made an investment in a biometric company, so onboarding of physical identity. That's how I like to refer to it. And so now, after all this time, we actually see people piloting these solutions in the wild. So where there's real solutions out there, where initially we just said, okay, you're wrong, but let's talk to you again in 6 months from now. Here's our thesis. Keep us updated, right? So, and that's fun. And that's the main reason why I'm personally in that space. It's super fun, right? You get to have a limited influence on how technology is going to change the world, hopefully, right? And hopefully for the better. At the same point in time, I see an enormous danger, and that's what I always instill in anybody that's working in this space. If we get this wrong, we will all live in Orwell's 1984, right? We all will be consistently surveilled, not only in our digital habits, but also in our physical habits. And we let surveillance money be reality, then also all of our spending and every single penny will always be known by everybody, and the government being the least interesting part of that. Anyway.
No, definitely, that makes sense. And that brings us to the conclusion of today's episode. And thank you for these wonderful insights. If you like, I'm speaking for the people who would be listening it. So there are 3 key takeaways for this that would be interested in you, instead of pitching it to everybody who has the VC title in front of their name. The second point is, make sure that when you are pitching to a VC, it might be a good idea to have a slide over there which says why you are the product that the VC should invest in, instead of like just going from the get-go as to this is my product, this is what we do. Thirdly, make sure that you have a wonderful team, because this final point has been the underlying theme that has driven through both of your answers, that you guys look for very dedicated teams and very energetic founders. So crack that, and I would leave a link to both of your websites at the bottom. So if there are any Web3 and privacy centric decentralized software solutions looking to raise funds, reach out to them and see what they have to say about it. On a closing note, Jamie and Christian, if you guys have anything to say to the HackerNoon readers, the floor is yours.
I'd just say you can follow me at Jevon on Twitter. The number's 247. Our website's outlierventures.io. And as you said, if you're a startup, seed stage, building for a business or a network in the Web3 paradigm, apply to our accelerator, which is outlierventures.io/.
Yeah, and what's up is I typically publish a new article every month, sometimes every other month if I have some ideas that I'd like to share. And the point there being, I'm not sharing this for kudos and claps. I'm sharing it for peer review, right? So as much as I like kudos and claps as everybody else, I really look for peer review. And so that's right at the end of this. And that's what I like about HackerNoon specifically, that I can update my articles, because I actually do. So someone tells me, okay, you're wrong about this. So I go back and actually revise that. But then at the end, you'll find a disclaimer that I do this, which some of the other magazines that I write at I cannot do that. I cannot update my Forbes art. Whatever mistake I made, like in hindsight, it's going to be memorialized there forever. And the other thing that we just started doing recently is we will help a couple of universities, including some of the Ivy League universities in these countries, with their curriculum. So if there's people that are in the educational space, we're happy to help out because we have the groundwork for this internally, and we would like actually to see this being taught, right? Because I am somewhat familiar with the topics that are still being taught in schools, in technology schools, and it's not preparing students for the future that we observe and that we predict. And so it's very helpful if we can share this. And so we found quite a few university professors being open to doing this rather than repeating the same curriculum that they've been doing for years and years, being more proactive to reach out to us and reach observations what we see being developed right now. That's the rare opportunity I think that they don't necessarily have, right? So they don't obviously get pitched 100 times a month by new startups that are developing new technologies. So call to action here is if you're in education or if you're a student and you're learning about quote unquote fintech, which is a terrible term. There was no fintech before blockchain, in my opinion. Then feel free to reach out to us, and we'll be happy to look at your curriculum and suggest some new topics and what to talk.
Perfect. Thank you very much, guys. And I'll be leaving all of the links in the description of the episode so that nobody misses them. And hopefully you guys find something that HackerNoon contributor writes and you guys invest in. I guess that would be job done for me. With that, I'd like to call it a wrap. Thank you, Christian, and thank you, Jamie, for being on the HackerNoon podcast.
Thanks for having me.